It is a pleasure and a privilege to be here with you tonight, and I am so excited to be sitting up here with two incredibly distinguished investment professionals. So the way we're going to work tonight is we're going to spend about 45 minutes with questions, dialogue. I think we might have a few arguments, and then we'll open up to the floor for 10 or 15 minutes of questions. And I think this promises to be an interesting discussion, even though we don't have a fireside to chat with. Okay, so let me start with Tony, and Ron, feel free to jump in after Tony answers. But the banking situation. We had a little bit of a regional banking mini crisis earlier this year. My question for you is, do you think it is over? Do you think it's something that could flare up again? Could it be systemic? And perhaps more importantly, what does it mean for credit conditions tightening going forward?
Hello, everyone. Thank you, all of you, for being here and for having us. It's a great honor. Well, first on banks, in reference to Robert's 97 years, I've worked in the business, so to speak, since 1983, so I'm 40 of that.
But you started in elementary school, right?
I started in elementary school. So I was looking at data, and I saw that from the FDIC that there were 1,600 bank failures between 1983, when I first began working on Wall Street, and 2000. Then another 600 since, so 2,200 bank failures. So, but think about the movement in asset prices. The S&P 500 since then is up 25-fold. What I'm trying to get at, the punchline is, it doesn't pay to worry in the long term about these sorts of issues. They're going to happen now and then. You might have read, perhaps, books about the panic of 1907, et cetera, et cetera, et cetera. Doesn't mean we should relax. There is something different happening, and we still have what's called the fractional reserve banking system, and we'll never get what Irving Fisher wanted during the Great Depression, which was a full reserve banking system. We're not going to get there. So these problems could happen now and then. We've got not a lot of time and we've got lots of questions, but so I'll just say on GDP, PIMCO thinks that the impact will be between 0.5% and 1% negative impact. It takes some time to show up. It is impactful when smaller banks aren't lending as rapidly as they could. They're big lenders in the arena for small businesses and for commercial real estate. So there's bound to be impact. But the final word I'll say is, it's only one of the 5 transmission elements, Christina, as you know, of Fed policy. It's channeled through stock prices, bond yields, credit spreads, the value of the dollar, and bank lending standards. And today with the stock market, things of that sort, and yields pretty stable, it isn't going to tank the economy.
If I could just piggyback on that, I would say one fact you should know is in the United States, 80% of corporate credit comes through the bond market, not through banks. So even if you have banking problems, again, it's a part of the economy. It's primarily small business, commercial real estate. If you pull out your wallet and look at your credit card, it's not a small bank, it's one of the mega banks. Number two, if you look at the last 6-7 weeks of deposit data out of the Federal Reserve, deposits have stabilized. So I think James Gorman said it best when he said, we don't have a banking crisis, there are some banks that are in a crisis. And we've seen that. I think there will be more bank failures, kind of echoing what was implied by your statement. I just don't think anyone's going to care from an economic perspective. And so, I would say from a macro perspective, I think this is maybe 10 to 20 bips of GDP, because honestly, if you look at the broader kind of credit markets, rates markets, financial conditions have eased pretty materially, and it seems that this is something that's largely behind us, not completely behind us, but I do think there's an interesting hypothesis of, could you have a Main Street recession but not a Wall Street recession? And by that I mean, could the big publicly held companies that go directly to the debt markets be fine? But if Christina and I are building a strip shopping center 20 miles out of Atlanta from here, maybe we'll have a hard time rolling that commercial real estate loan. Maybe that's where the problems hit. But again, from a macro perspective, probably not that material.
I would agree. I don't think it's systemic, but I will say that if the Fed does hike rates more, I think that increases the risks that you have more, banking issues. So we talked a little bit about commercial real estate. Is that the next shoe to drop? Ron, you want to take it first?
It's the question that comes up in every meeting I have in and outside of the United States. The total amount of commercial real estate debt outstanding in the US is somewhere around $4.7 trillion. The problematic part of that debt is office, which is about $1 trillion. And so if you really want to think about stress testing, let's be draconian. Let's say 40% of all the office loans default in the United States and you lose 50% on every one of them. $200 billion just isn't that much money in the big picture. I mean, I'm sorry, it sounds weird to say that. I'd like to have $200 billion, but in a macro perspective of $26 trillion GDP, it doesn't move the needle. And if you consider, too, that doesn't happen all in one day, that's likely going to be spread over a number of years. And by the way, it's also not all in the banks. There is a disproportionate exposure, again, of smaller banks, i.e. the banks below the top 25 by deposit ranking. But even there, it's not like you're going to basically have it all hit at once, and these banks can earn their way through it, contingent on not having their net interest margins compressed by Fed rate policy. So I do think it's an issue. And by the way, this is a global issue. It's not just a US issue. Putting our investor hats on, I think this is going to create some of the really most interesting opportunities in the next 5 years for distressed real estate investing. We don't do this at Lazard, but I think there are plenty of fund managers out there who can offer you a product. It's too early to buy now, too late to sell, but I think there are going to be some pretty amazing opportunities in distressed sales.
Yeah, we would agree with that. It's obvious that there'll be disintermediation and that money will have to flow from the private sector. So if you've got an endowment style model with your portfolios or mindset, there'll be an opportunity to diversify into these sorts of credits because there'll be many entities looking for money. I'd also echo what Ron said in talking about the stock of debt and thinking about the flow perspective on GDP. It's really tiny, call it 1 to 2% in that zone. So even with a big hit to commercial real estate there from a flow perspective, it's not going to be all that great. Final word is that there will be, as Ron said, opportunities, probably because there'll be some headlines, a lot of headline risks. There's some things that'll happen. If there's any liquidation of assets today in that sector, it's going to be the good assets, the high quality ones. The lesser quality ones get sold later, and that's at a time when many will be facing maturities on debt. There's a wall that's a couple of years out in many cases, and there'll be a lot of pressure then, so lots of opportunities.
Absolutely. All right, so Ron, let's talk a little bit about near-term inflation. Mm-hmm. We obviously know the Fed is still very concerned about core being stubborn. Why do you think that is? Where do you think we get to by end of year 23? And my third question for you is, will the Fed be able to get to that 2% target by the end of 24?
So I'll do in reverse order. Yes, by the end of 2024, it's going to be tough. Exiting 2023, I think our core run rate will be between 3 and 3.25%. So again, I'm saying basically December of 2023, we'll probably have a core CPI around 25 basis points for that month. I can go through the weeds if anyone wants to afterwards, but you might want a cocktail for that. But if I look at the first part of the question, the reason the Fed's concerned, I never thought I would sit on a stage and say this month's inflation reading was good because it was only 44 basis points on core. For the 5th month in a row, you're over 40 basis points. That's an abysmal inflation situation. But when you peel back the onion, 14.7 basis points of the 44 was used car prices. Another 6.3 basis points was car insurance. So 21 of the 44 basis points is cars. Now, by the way, if I go back to June of 2021, I would have said, look at cars, it's transitory, you can look through it. They still seem to be causing noise. But when I watch dealer incentives and what's happening with new vehicles from the OEMs, we're starting to see an inflection where discounting is starting to come back into the market. And I think you're going to see softness in used car prices through the rest of the year. Put a different way, you're not going to get plus 15 basis points. You might get a 0. You might get a minus 6. And so I think once you kind of bend that curve, get those core goods out of the equation, shelter inflation, 43% of core CPI. Owner equivalent rent of a primary residence were 50 basis points this month. Still too high, but it was 80 basis points at the beginning of the year. So again, heading the right direction. We watch the Zillow data. We see it's going lower. And then finally, the big wild card in CPI is watching all other services excluding housing. And that one's a bit tougher to predict. We were at 24 basis points this month on a month-on-month increase. I'm in the camp that still believes labor has to be the linchpin there, but it's not showing up in the numbers. So you've got an incredibly tight labor market, 1.65 open jobs for every unemployed person, 314,000 jobs a month for the first 5 months. We need 140,000 jobs a month to keep unemployment constant, and yet wage growth isn't proving problematic. So if I'm sitting at the Fed, it looks to me like you might be threading the needle pretty damn well. I mean, inflation's coming down, you've got confidence it's going to be lower by the end of the year, but the labor market looks good. You know, could they pull this off? I think it's looking more likely.
Definitely. Tony?
We would agree, and we're looking for something like 3.5%, below the Fed's near 4% for end of year, and somewhere in the mid-2s by next year. The way to think about it is 2 point something rather than the 2.0 that the Fed wants. And to add to Ron's comments on automobiles, today in the industrial production data show that auto assemblies rate for the last 2 months is quite high, the highest in a few years. So that'll put more supply out there. The Manheim index of used car prices is coming down. And on rents, the Zillow index, one of the top things to follow, it's more moderate. Yesterday in our daily meetings of the investment committee, we had a meeting post-FOMC with Ben Bernanke. He's an advisor to PIMCO, and he, like many economists, like to look at wages, as Ron said. It's the important thing. It's the key for services. But the figures there have been getting better, and the simple math on how to come up with an inflation forecast is take the wage figures, subtract productivity. And you know, recently had a 4.4, I think last month, 4.2 the prior, so call it low fours, subtract the 1.5 of productivity, till you get eventually into the high 2s. But with the tight labor market, getting to 2 might be tougher in the longer.
So let's turn to very current events. The FOMC decision yesterday and more specifically the dot plot and the press conference. So do you really believe that the Fed is likely to hike rates 50 more basis points this year?
We do not. We think there'll be another hike in July. Markets have the same kind of thought. Bigger picture story, though, is to not worry about it from an investment perspective. The forecast missed last year. Markets thought 1%. It turned out eventually to be 5%. If markets think it's going to get to, I guess they think I'm not talking loud enough. If markets think that the rate is going to be 5.25%, 5.5%, and it's a little higher than that, from a market perspective, it probably won't change things much, and there's enough progress being made that the Fed probably won't have to do a lot more from here. Oh, a final word is, you should be counting in something for QT. There is impact. You all know from mortgage rates, I'm getting hit with a 6% mortgage rate this week in a closing at the Jersey Shore. And you know I'm somewhere near the Jersey Shore with this accent. I haven't seen Snooki yet. She's somewhere nearby in the neighborhood, apparently. But these high rates reflect QT in part. Mortgage-backed securities have had a yield spread to treasuries nominally, I've called it 170 lately, close to where they were during the global financial crisis. The normal spread is half that. So some of that's QT, so there's value in that. What I'm trying to say is the Fed needn't keep going and going and going simply based on where the rate should be. QT has some impact too, so it doesn't have to do as much. But it's hard to say, and Ron, we were talking about this earlier, who really knows?
So let me take a slightly different view. I mean, I think the more the equity market goes up and the more benign market conditions are, the more likely it is the Fed raises rates. I mean, effectively, you know, your goal is to tighten financial conditions to tame inflation, and the markets are basically pushing exactly the opposite direction. So at this point, I would bet that there's a good chance the Fed will do 2 more hikes, but probably more important than where we peak is how long we stay at that peak. And I think we're going to have the Fed keeping rates high well through much of next year. I don't buy the idea that we're going to have a severe enough response. I'm not sure we'll even have a recession. I think we all obsess a little too much with the R word. Bottom line is the economy is going to stall out in Europe and the US in the next year. That's not enough for the Fed to feel they have to basically cut rates substantially. So I think they're going to keep rates at 5+ until they know inflation is locked and loaded. And Tony's right about inflation still having a 2 handle at the end of the year. Then why are they cutting rates? And so this has been a big divergence of my view versus the market for the last 6 weeks, but it's really interesting. On May 4th, the Fed funds futures for March of 24 said Fed funds would be at 375. As of today, they say we'll be at 5. Now, the market's gradually getting there and saying, okay, the Fed's not going to be cutting rates. Maybe there's another 25, 50 basis points, but we're not far from the baseline. So,
but interesting, Ron, even though the market's taking out these cuts, and Christina, you know, at one point the market thought July for a cut.
Yeah.
Yet, even with the reversal of all of this, the equity market's been fine. So it probably demonstrates that it's not, perhaps not vital to the performance of markets that there are rate cuts, but it probably could affect them next year.
And I think that the dot plot lacks credibility anymore, just because we've had so much in the way of divergence from what the Fed has said and where we ended up. I always point to the example of December of 2021 and that dot plot showing the Fed funds rate at the end of 2022 being 90 basis points, and in reality it was 450. So it's hard to give the Fed a lot of credibility when we look at the dot plot. I was struck, though, by a quote from Janet Yellen back in May 2006. Now, back then, of course, the FOMC minutes were a bit different, and there were quotes attributed to individuals. And she had warned at that meeting, she talked a lot about 94, and she said, it's instinctual. It's natural to want to keep raising rates from here because we worry about the upside risks to the economy. But in fact, in 94, we did it right. And I think that right now we have to worry about a significant policy lag. Obviously, I'm paraphrasing. We have to worry about a significant policy lag. And so it would be far more prudent. It would be a mistake. We would be overshooting if we hike rates from here. And I think about that because we had a very aggressive rate hike cycle. And I don't think do you think we've seen a lot of that already impact the economy? Or do you think that that is to come?
Well, the way I tend to think about this, and this is where I put on my glass half empty or maybe glass completely empty view, is we had 13 years of negative real interest rates. We had $15 trillion of QE in 2 years from the Fed, the ECB, and the BOJ. I'm ignoring the RBA and BOC and the BOE. And we had $10.5 trillion of fiscal stimulus in 2 years, half of which was in the United States with basically 6% of the world's population. How can you tell me you're going to raise rates 500 basis points, you're going to have $780 billion of QT in a matter of a year, and the only glass you're going to break is Silicon Valley Bank and some crypto? It seems unbelievable that that's all that could go wrong. And by the way, I was trading fixed income in 1994 in a bank in Boston. Definitely not a PIMCO. We were a minnow. But going from 3 to 6 on Fed funds blew up some balance sheets. Orange County, was it American Greetings, IG Metallgesellschaft, basically had, and I'll never forget an investment bank from Switzerland that had tried to pitch us LIBOR squared reverse floaters. I think it was 16% minus LIBOR squared was the yield. It sounded great when LIBOR was at 3. When it was at 6, it was a pretty lousy trade. And so, we had excesses. I've covered financials for 20 years, worked in banks for a long time. I can't find the systemic shoe that's going to drop. It's not commercial real estate. It's not resi real estate. Levered loans could go wrong. They're not big enough. Private credit maybe could go wrong. Not big enough. The only thing I can find that's big enough to and by the way, the banking system, half the leverage we had in 07, 08, much more regulated. It's hard to find something going wrong, but I just keep thinking the definition of a surprise is we don't expect it. And I worry that there's something lingering out there, and the only thing I could think of is sovereign credit issues, but it's not going to be the United States.
But
unless we choose to default on our debt, which we've passed.
But let's not think in terms of markets, let's think in terms of the economy. What if it's unemployment? I think about the SOM rule, right? Are we, what is our probability of recession, a significant sort of broad-based recession? What is that probability today?
Well, to Ron's point, it's difficult to see big systemic issues that can cause a kind of shock that many say will bring the unemployment rate to over 5%, especially given the job openings to unemployment ratio, et cetera, et cetera. There's too many. The initial conditions for the economy today are pretty good, just in terms of balance sheets. I think, for example, household balance sheets, household net worth, new data from the Fed last week, I think it was, the quarterly flow of funds report. It shows household net worth at $148 trillion. It was up $3 trillion last quarter. Now that's up $45 trillion in 5 years. Seems like a lot of money. There's that, and there's the saving balance story, and housing, which is part of the net worth story, which we think holds up because of the main factor that drives so-called HPA, home price appreciation, inventories. The underbuilding of homes last decade, according to the NAHB, the Association of Home Builders, was severe, meaning building activity was half of every other decade the past 50 years. So we've got a shortage of homes, and people are born short a roof over their heads, and so they've got to cover at some point. So in other words, prices hold up because inventories are so lean, except locally, of course, and that keeps the spending thing going. So it's hard to see a deep recession. And finally, just a final quick comment is the labor story won't change easily because of massive retirements. The last century, the biggest birth year was 1957. So it was 65 and a half years ago, and you can receive Social Security benefits at age 65 and a half. So we've had lots of retirements, the biggest retirement wave ever. And till the last boomer, which is me, born in 64, turns 65, got to pause, in 2029. So it's going to last a long time, so it's going to be difficult to get the jobless rate up meaningfully, which is another way of saying difficult to get wages down meaningfully, which is supportive of the economy and, in general.
I agree with Tony. I mean, I think the probability of a severe recession is really low. If I think about what could cause a severe recession in the next 5 to 10 years, we did a lot of work on this 5 years ago about what I thought was the looming retirement crisis. I mean, if you look at Americans aged 55 to 64-year-old head of household from the flow of funds data, actually this is from the Survey of Consumer Finance every 3 years, only 60% of those households, again, head of household 55 to 64, only 60% have any retirement account in the United States. And for those that have a retirement account, the median savings was $120,000 in 2019. It sounds like decent money for a typical person who drives your Uber at night. 120 grand doesn't last very long when you're basically retiring on Social Security. And so I worry that maybe the next recession is going to be one that's going to collide with socioeconomic issues around aging and inequality. We already have these divergences. Well, we already have an incredibly polarized society where, arguably from a fiscal perspective, we spend way more on elderly people than we do on young people. Not exactly a great way to invest in being able to support elderly people down the road. So I think those are the issues that I worry about in terms of deep recession. But in the near term, agree with everything Tony said. It's hard to get to a major issue absent some kind of exogenous shock. One last thing I should say, geopolitical could cause it. I mean, if Ukraine crosses a red line in Crimea and Russia decides to use a tactical nuclear weapon and NATO gets involved, that probably changes the story pretty badly. Interestingly, nat gas prices in Europe have doubled in the last 2 weeks. Now, they're down 80% from the peak, so still good, but they were down 90%. There are a range of issues there. And China-Taiwan's the obvious big issue too. So there are things like that could go wrong, but I don't know about you, Tony. I don't have a model that can forecast those pretty well.
So there's an election in Taiwan in January. That's the first marker, for that story next year, then our own election.
Right.
So you touched on demographics, and one of the questions I think we all get a lot of is, between demographics and deglobalization, won't inflation be higher in the next decade than in recent past decades? What do you think about that, Ron?
I do think inflation will be higher over the next 5 to 10 years, but it's not because of demographics. And I purposely do not use the word deglobalization. I don't think we're going to deglobalize. I think we're reconfiguration. We're moving the chess pieces around on the map. And I guess I would say there are two things that led to low inflation let me give you some context. 2009 to 19 in the US, core inflation was 1.7% per annum. Eurozone core inflation was 1.05%. I think over the next 5, 10 years, 2.5%, 3% in the US. And the way I get to that is, number one, the supply chains. Number two, the cost of the energy transition. Supply chains, goods inflation in the US from 1997 to 2019 was 4 basis points per annum, core goods. So we basically had zero inflation in core goods, ex food and energy, for 22 years. Thank you, NAFTA. Thank you, WTO, for China. You add 500 million workers to the supply of labor, you get lower labor prices. You crush blue-collar bargaining power, and we all got zero inflation at Walmart and Target. I think that's over for 3 reasons. One, Chinese workers aren't that cheap anymore. It's $30,000 a year to hire someone in coastal China now, not $3,000. So your arbitrage or your ability to export deflation isn't what it used to be. Number two, companies are moving supply chains. They got too extended. They weren't resilient. They weren't dependable. That's going to be more expensive. And number three, domestic workers have more bargaining power. Now, we did just have a big immigration year in the US in 2022, back to 2017 levels. But if you look at the highest wage growth in the US is low-wage jobs, historically filled by immigrants. The UK with Brexit, there's high wage growth. So you put all those together, I think your goods inflation could easily be 2-3% per annum. Services inflation for those 22 years was 2.9% per annum. Reason number two, though, energy transition, and I'll try to be brief and punchy. IEA assumes we're going to spend $175 trillion over 30 years on the energy transition. For everyone in this room, we need fossil fuels for the next 20 to 30 years, but we're going to build an entirely new infrastructure alongside it. We're going to pay for both of them to use the same amount of energy. That's inflationary. But I worry, more provocatively, we're underinvesting in renewables. We're not going to get there fast enough. I think 2 degrees centigrade is going to be incredibly hard to achieve. And if you get to 3, 4 degrees, you get all kinds of tipping points that are incredibly expensive. But we're also underinvesting in fossil fuels. Sounds contradictory. But if you don't invest enough in the fossil fuels to get you to that energy transition, to that inflection point where you can rely on renewables, could you have oil at $150, $200 a barrel? Easily. And Bernstein thinks you'll have peak oil demand in 2029 at 109 million barrels per day equivalent. Where are we going to get that extra 9 million barrels a day if the big integrateds are not researching or not digging more holes, spending on CapEx? And sadly, all the big integrateds listened to all of us because we said we want better ROIC, we want higher returns on capital. They're like, fine, we'll give your money back, go use it where you want, but that means you don't have enough energy supply. So I put all that together. I think it's incredibly complicated. I could be wrong on any piece of it. Last footnote, most likely reason for me to be wrong is if generative AI really knocks the lights out on productivity and services. But then you could actually have a scenario where service inflation is 0 for the next decade, but goods inflation is 3%. You've turned the 1997 to 2019 on its head.
Well, since you brought up generative AI, is this a good thing or a bad thing?
Yes. I think it could be amazing for productivity. The easiest use case is when you go to Chick-fil-A or McDonald's tomorrow and you basically order, do you need a person on the other end of that mic or could AI do all of this? And by the way, if you have a funny accent from New Jersey, or if you have the accent I had from East Texas where I grew up, AI can figure that out. So that could be good, but I just worry without regulation, and I'm not sure you can regulate AI, but I worry that in a world where AI can imitate Tony's voice with perfect accuracy after 5 to 10 seconds and can also imitate my voice and with deep fake videos, what happens to democracy? We've got a country where people can't tell fact from fiction already, and it's pretty horrifying what you can imagine you could say a political candidate said when they never said it, and how do you know what's true? And so that kind of stuff really worries me, and maybe I've watched Terminator too many times. And by the way, watch Ex Machina, great show, good scenery.
Oh, that's
Norway.
scarier.
No, but that's kind of the direction we seem to be heading.
So you sort of almost skimmed right over something that probably scares a lot of people, which is what happens to employment, right? You talked about replacing lower wage workers. So what happens? Are we in an environment where we're going to have to be giving basic income to a lot of Americans? Is that what you see for the future with generative AI?
I don't know if our country is prepared to have that debate rationally for universal basic income. I don't want to depress people. Hopefully there are cocktails after this, but
Ron, I hate to tell you, but you're going in that direction.
I'm going there.
I
Okay.
mean,
Well, I've only.
I hope the bar's open.
So far, productivity's up, but you don't have democracy. You win some, you lose some. But think about it. The last 30, 40 years of globalization have been all at the expense of blue-collar workers. AI is all at the expense of white-collar. I mean, the finance industry is ripe for the picking. I mean, there's so many jobs that you don't need people for in finance if you use AI well. And so, this is a clarion call, I think, for anyone who has kids here to make sure they're getting as much education as they can and being, but even there, it's incredible what AI can do. So I think the job losses could be spectacular. And you're going to have the socioeconomics, the social safety net packages that we did not do well for blue-collar workers. But who knows, given that white-collar workers give all the money to politicians, maybe it'll work out better this time. Sorry,
okay,
not to be cynical.
So Ron,
Sorry.
Trying to get more upbeat, I'm going to turn to the fixed income guy. Can you imagine that? But Tony,
Go ahead, Tony.
Tony, we talked about the Fed, but we haven't talked about the Bank of Japan, right? And that's a big question mark right now. Do you think anytime soon they're going to alter their yield curve control policy?
Yes, we think it'll be rather soon. So Ueda, the new BOJ governor who started, his first meeting was April 28th, I believe. He pretty much kept everything that had been in place under Kuroda in place. So he wants to do a typical Japan culture, is to move gradually, slowly, not rock the boat. It's possible, we think, in the July meeting, we think is a live meeting, not this week's meeting, where they change the band perhaps on the 10-year, which of course is 0.5%. They could widen it to 1%, 0.75%. We think the fair value for, this is from our Japan office, for the 10 years somewhere like 80 basis points or 90 basis points instead of today's 40-ish. So there would be a big jump then in yields. Obviously, they don't want that to happen all at once, so they would have a gradual move in that rate. Or they could simply say, we're no longer targeting 0 to half, it's 1/4 to 3/4, or shift to the 5-year, let the 10-year kind of be on its own. Lots of different choices, but in the end, they'll say as well, don't worry, we'll still be big buyers of bonds so to stabilize the market, to ensure proper market functioning. So we do expect some changes in the markets as well, and it's a little bit of a crowded trade, but it's likely to happen by October.
By the way, one of the other things that I've been expecting and hearing from other people, and you tell me if you agree, is that even when they change YCC, that they're going to probably extend forward guidance to try to make sure everyone knows this does not mean we're going to raise rates. I mean, do you buy into that view?
Yeah, we think, I mean, as you know, the rate is minus 10 basis points in a world that's gone away from negative rates. It's quite possible we think they'll simply just move it to 0. But not much of a change in the base rate beyond that we can foresee for the next year.
Because to me, what's interesting about this, by the way, is you can have the BOJ, let's say at 0. The UK, the BOE might be at 5. If the market's right, the BOE is going to be at 5.75. The US could be at 5.25. ECB 3.75, 4. It's the first time in 15, 20 years we've had that kind of degree of monetary policy divergence, which seems to create some real risk and opportunities around currencies. And I would think for all of us who invest globally in equities, the operating environment in Japan with 0 interest rates is going to be very different than the operating environment in the UK with 5.75, and the companies that have strong balance sheets compared to the companies that are highly indebted, you could have a lot more single security dispersion across markets. It just seems like it's going to be an opportunity that's going to be great for active managers.
Oh, absolutely. Even if you're looking at sort of the dichotomy within most major economies, where you have services doing well, manufacturing not doing well, I mean, you dive down into this environment, I think it's ripe for active management. But let me get back to Tony and ask about USD. What happens to that this year? Is this a weakening story, or is it going to stay in a sort of a pretty tight range?
General view should be, since the U.S. is ahead of the rest of the world, including Europe, for example, which still will likely keep raising rates beyond when the Fed stops, the dollar will probably weaken over time, but more versus, we think, emerging markets currencies, which come out, we think, as a winner in the next 5 years from the big tumult in the world. The China Plus strategy, trying to do nearshoring, friendshoring, China Plus type strategies, sourcing commodities like the rare earth elements that we get from China that we need for batteries, et cetera, et cetera. The shift in service, in sourcing out services, et cetera, will probably wind up in the emerging markets. So EM currencies look good to us versus the dollar. But if you wanted to transact, you can consider diversifying by using the euro as a funding source as well. So both are vulnerable. But the dollar as the reserve currency, it's not under threat. We could easily say that and sound complacent, but what reserve manager by any major nation would want to keep their money in China, given what's happening and the chances of some big problems and your money getting locked up and in a liquid market as it is. But what I see personally is, so the dollar is something like near 60% of world reserve assets. Is a plurality. Someday we'll be at 49% of reserve assets, and China you'll see its currency ascend, and the euro perhaps, who knows. But the dollar will remain dominant for a long time.
What do you think, Ron?
I would agree with the idea on the emerging market side. In fact, I think local currency denominated EM debt could be a really interesting place to invest over the next 6 to 12 months. Getting double-digit yields, again, I'm saying if you avoid some of the worst borrowers out there, you can actually still have a good quality portfolio, and actually you have a duration play and you have a currency play. And again, this EM central banks were way ahead of most of the developed market central banks in tightening, so you're actually going to be in a different part of the cycle. So I'd agree with that. On the dollar against the other majors, I still tend to expect the dollar to strengthen on the margin a bit more against the yen. I mean, I think the yen's going to be the weak currency. Dollar euro, probably locked in somewhat of a range. I don't have a particularly strong view either way on that. Yes, we're ahead of the ECB, but are we really that far ahead? I mean, we're talking about 1 or 2 more rate hikes here, but they're talking, Lagarde today basically guaranteed 1 without guaranteeing it. Yeah. So, I don't see that much of a divergence in terms of the expectations. So, relatively stable.
So Ron, let me stay with you and ask you about earnings, S&P 500. How bad are they going to get this year?
I think consensus for this year is somewhere around -1 or 2% for the full year versus 2022. Consensus for 2024 is +9%. And historically, in a typical recession, I'm not sure what we call a typical recession anymore, but in a typical recession, you'd have -10 to 15% on earnings. I don't think we're going to get a typical recession if we have one. By the way, you asked earlier, chance of recession. Chance of a recession, in my view, is probably 35%, but I'm talking like -30 to 50 basis point GDP, kind of like Eurozone had for the winter of last year. You don't really notice the difference between recession and growth at that point because it's basically a zero growth. But that says to me, if we dodge recession next year, growth is going to be close to zero. Maybe if we're lucky, 50 to 100 basis points. I'm not sure I buy the 100 basis points idea. That's not an environment where earnings grow 9%. And so I do worry that expectations for the S&P more broadly are a little too optimistic. But I'm thinking, could 2024 be flat after a flat year this year? Seems like a reasonable assumption, in which case the market's pretty pricey.
So looking at sort of the world of options for equities, what do you favor in terms of what would be your most favorite country?
On a one-year view, I would say developed market, oh geez, that's a tough one. Developed ex-US over US, and developed, I should have said developed ex-US over EM, EM over US on a 12-month view. Within developed ex-US, it's a tough call between Japan and Europe. The problem with Japan is, man, 33-year highs. We've had a nice big move. I think there is a structure.
But we're only back to where we were 30
It's still
years ago.
cheap, and it's a structurally good story around what the Tokyo Stock Exchange is doing in terms of new regulations, that if you trade below book value for an extended period of time, it's incumbent on the company to explain what you're going to do about it. That is new, and it's a big deal. But when I look at Europe, I also see some pretty significant right tail optionality. At some point, the Ukraine conflict is going to reach an armistice or a ceasefire. I don't think we're going to get a peace agreement, unless, by the way, be careful what you wish for. If Putin forgets to wake up tomorrow, you're not guaranteed a better person. It might be worse than Putin, right? Prigozhin is a pretty horrifying guy from the Wagner group. So, I mean, let's say at some point you reach a ceasefire in Ukraine, that's material upside to the Europeans. China's going to get through the second wave of COVID they're in right now. They're going to get fiscal stimulus. That's more positive for Europe than it is for the US because you got outbound tourism, and Japan also benefits there. So it's a tough juggle between Europe and Japan for me. But I think those are on the one-year basis. On a 5-year basis, I could put my flag pin back on. Where are you going to get growth and innovation in the world? The United States and maybe China. I mean, if you think about where the tech industry is most exciting, those are the two places. I think we could probably name every good tech company in Europe in one hand or two. So, that's where I tend to think back to the USA, but right now I see more opportunities outside the US.
So Tony, looking at the world of fixed income, what are you most excited about?
Well, yields in general. So look at the Bloomberg aggregate. It's yielding about 480. Credit aggregate's about 5.5. Last decade's easy comparison is 2 points higher than that. If I go back 20 years, it's higher than that, 25, 30. I'd have to go back 40 years till I find a higher number, and only by about 20 basis points for the 40-year average. So relative to history, yields look quite attractive. Relative to expected inflation, this is more subjective, looks attractive. The market thinks inflation will fall into the 2s. We do. So relative to that, the real yield looks pretty good. And relative to expected volatility, it looks good. And we say, and that's also subjective. Last year was massive volatility. Can we return to that? Not likely, because things are breaking the more that rates go up. So it's, in some ways, any increase in yield from here would be self-stabilizing because it would cause so much damage that we get negative correlation to these other assets. So just fixed income in general. That's number one. Secondly, and this is, I'm not trying to tout PIMCO type stuff here, but core fixed income. And I have lots of T-bills myself. I'm playing this game, hanging on, because it's better than the yield I just mentioned on the ag. I'm playing this game, staying in T-bills. But I know the data, that 4 months or so prior to the peak in the funds rate, core fixed income starts to knock the socks off of T-bills and cash on a 3-year rolling return basis by an average 3 percentage points dating back to 1978. So I want to have a little more duration. So in terms of risk factors, I'm going to play it a little longer because I do this thing. It's like me last week. The mortgage guy said, "Do you want a lock?" I said, "No, I'm confident in the CPI. I'm confident the Fed won't move. I'm going to play the game." Because he wanted to charge me $2,000. So I can play this game because I'm in the market. I do this stuff. But for the average investor, I would say, don't play the game. Have some duration. Think in terms of risk factors. Final thing is, in terms of the glaring asset to us, we bought a few today. Agency mortgage-backed securities with that high yield I mentioned, they're getting hit by FDIC sales, the Fed's selling. It's a liquid asset, half the daily volume of treasuries, 300 billion. It's a way to tow into spread markets without taking meaningful credit risk. So it's an asset we like amongst others in the credit realm, but want to be careful and stay in high quality.
So now that the debt ceiling has been resolved, it's estimated that the U.S. Treasury will be issuing about $850 billion in debt over the next several months. What, if anything material, is that going to do to the Treasury market?
Well, new data today, in fact, on the reverse repo facility showed that there was a $117 billion decline to under $2 trillion, which is the first time, I think, in a year that it's been below $2 trillion. The importance of that is that money invested there, I know I have a money market fund that 90-something% of its money is in overnight repo, so it's in this facility. So these money market funds, in other words, took the $117 billion, looking at how many T-bills settled this week, it's almost the same number. So long as the money comes out of one government balance sheet, you call it the reverse repo facility, goes to the other one, Treasury, everything's fine. But if it comes out of banks, you take your money out of your bank to buy those bills, it's a problem for some banks potentially. If it comes out of other assets, it's a problem. But so we're not expecting significant impact. And today was a good sign that perhaps the money market funds will eat up those bills.
And one more question for you. I'm sorry, Ron.
Go for it.
Outlook on private credit.
Ron and I talked about this idea that opportunities will surface in the time ahead because there'll be stress in certain areas, partly because of, and general theme is disintermediation and other factors. It's an area that is lagging the public markets, it's private market, in terms of mark-to-markets, and so we would expect that there'll be losses, especially in the economically sensitive areas. So lots of great opportunities, but you're going to have to be really picky, and I'm not going to be the one to do that. PIMCO has people that invest in private markets, and you want to have lots of expertise in that area because you can really get hurt badly if you're not careful. But lots of opportunities.
Ron, have you been worried about how narrow the stock market has been? They're calling it bad breath. Are you comfortable with that?
No, I think the narrowness of the market has been problematic, but if I go back 2 weeks ago, when the S&P was only up 11.5%, the entirety of that gain was 10 stocks. As of today, with us up 16.2%, the top 20 stocks are 95% of it. So we are seeing breadth widening. The Russell 2000 was significantly lagging. It's still significantly lagging, but now it's up 8% year to date, where it was up 3% when the S&P. So it's interesting that the market seems to have hit this kind of inflection point where people are starting to think, I missed out on those 10 big tech stocks, but I can buy other stuff that's not up much. One other quick anecdote, well, two others. S&P up 16.2%. The median stock in the S&P 500 is up less than 4%. So yes, the index is up, but the market, more broadly speaking, is not up, and maybe that reflects the earnings challenges we're seeing in the rest of the market. And then the last little anecdote is if you look at the top 10 stocks in the S&P 500, the worst performer in terms of contribution to the index, the worst performer is Alphabet because it's only up 41% year to date. So, it's pretty insane to look at those numbers. These are not companies with small P&Ls that are growing rapidly because there's a huge TAM that they've never tapped. They've got a huge TAM that they've already tapped that we're now extrapolating even further. And so I guess the way I think about it is, and again, I'm in an active management firm, so you can take this with a grain of salt, but is this a time when you want to decrease your index weights, your indexed holdings, and basically go into something active where someone can help find those unearthed gems in the market, find those small cap companies, find those companies that are not in the top 10 tech stocks? I think there's some real opportunities there. And I would say do it globally. What's amazing to me, by the way, when I travel around the US, how few people buy global funds. When you give your manager 6,000 choices instead of 2,000 or 3,000, funny thing happens. Sometimes they make better returns. But a lot of Americans have always been we have a US allocation, a non-US, and an EM, and we bolt it together, especially if you're an advisor, that's kind of part of your job. But I would say go global on that front. But I do see breadth narrowing. I think you're going to see a lot of churn, and maybe we end the year with the market lower is my expectation, but it might be at the expense of the 10 stocks that drove the year to date, and maybe not at the expense of the rest of the market.
Well, that's a great segue to our lightning round, right, before we open up for questions. These are very short answers, and I'm just going to hit you with the questions. And I'll start, Tony, then Ron. 10-year yield at the end of the year. We're going to hold you to it. I'm kidding.
Can I have an average yield for the last quarter? In the current zone, I think, yeah, in the current vicinity.
Ron?
Yeah, I think we top 4% before we get there. I think we'll see a 4 handle, then by the end of the year, we're probably back down where we are now.
S&P 500 at the end of 2023.
Up 5% from current levels.
4,200.
I like that divergence of opinion. Best performing major stock market for calendar year 2023.
Major market, Japan.
Japan.
All right, consensus. Biggest risk to you?
Short Japan. Anyway, sorry.
Most crowded trade.
Top 10 tech stocks in the U.S.
Massive short base in futures in the bond market. Historic.
Hidden gem or underappreciated gem.
Private markets, but you've got to be really careful.
I'm going to cheat and give you 3. Converts. 35% of all the convertible bonds in the world have a yield to maturity over 5%. You're implying 0 call option value with a 3-year weighted average life. There's some upside in there. 2, I think small cap. Profitable small cap companies are trading at 13 times forward earnings in the US. That is a 3 standard deviation discount to large cap. We don't typically see this. And number 3, I think in a world with higher inflation, infrastructure. Maybe it's not a hidden gem, but it's going to work. If you get 3% inflation, that's a perfect environment for pass-throughs and for good returns.
What keeps you up at night? Besides caffeinated coffee.
George H.W. Bush, read my lips. 1990, he said, read my lips, no new taxes. He had to break the pledge because the interest on the debt was 3.2%. It was the most ever. Hasn't been breached yet. In 5 years, we're going to get there. We're going to have lots of challenges. We had good politicians that figured it out. Clinton came in, we had a surplus eventually. I'm not so sure what's going to happen this time with all the debt we have and the mix of politicians, that thing. And of course, the geopolitics stuff, that's a given.
By the way, to add to that scary thought, the CBO, I think, is assuming a sub 3% interest rate for the next 10 years. So if you look at the deficit forecast of 5 to 6% of GDP, that's with a very optimistic interest rate assumption on servicing your debt. I sleep really well at night. Right now, other than the geopolitics, I worry about the demise of democracy. I worry about things that you can't quantify. The geopolitics are scary. Things like AI and democracy are scary because even if you knew tomorrow that North Korea was going to launch a nuke that hit San Francisco, what are you going to do with your asset allocation? It's not easy to answer that question, but I think we should think about it. We should recognize where we have vulnerabilities in our asset allocation that really might not be worth the vulnerability. And so, maybe that's one way to try to build an infrastructure or framework around geopolitics. I think it's probably the most ignored topic amongst investors, and it's largely because you can't quantify it and it's hard to know what you would do, but that's not an excuse for thinking about it and really assessing the risk.
One last question in our lightning round. It is almost the technical start of summer, and so that's summer reading time. One book you'd recommend, macro market related, that would make for great reading this summer?
No, I'm going to pass on macro market related. I do that stuff all day long. The last thing I'll read at the beach is about the market. I will give you 2 books. One I haven't finished yet. One is In the Garden of Beast. I would say any book by Eric Larson is phenomenal. It's written like a novel, but it's all nonfiction. In the Garden of Beast is a story about the U.S. ambassador and his family to Germany in the 1930s. pretty shocking what went on. Things like JP Morgan saying, don't push Hitler too hard, they haven't paid us back for World War I yet. Telegrams saying we have a Jewish problem too, from the ambassador to the president. And oh, by the way, our ambassador went on a blind date with Hitler, which I didn't know. Great book. Any of his books are good. The other one I'm reading right now is An Immense World, which is about how different animal species perceive the Umwelt, or the atmosphere around them. It's really intriguing because we tend to think that the atmosphere is what we see, smell, and hear, and taste. Other species have a completely different atmosphere, and it kind of really twists your brain around, and I think that's really good to do for an investor.
Tony.
There's 2 books by Kai-Fu Lee on AI, and I don't tend to worry about it too much. I'm in the Schumpeter camp.
But he wrote that book 4 years ago.
Right.
Sorry, great book.
But there's, generally speaking, think of the technology shock, 1995, people worried about lots of things then, and look, today we still have a jobless rate under 4%, tight labor markets, in other words, you can get lots of change, and turns out for the better in some ways. So I don't worry so much about AI, just because throughout history, inventions have never really tanked the job market. We've continued to have more and more jobs. But this does seem a little different, and it's intertwined with China and that whole nexus there. So I want to learn more about it and understand it better, so I don't get too complacent about it.
And I will recommend any book that Tony wrote, and there's 6 you can read. Okay, so now thank you so much for being so patient. We are going to open it up for questions.
Testing.
Actually, 2 questions. Thank you. Question about AI, 2 questions. What is your firm doing in the way of applying, researching, in terms of AI activity? And what are you doing in your portfolio structures to capitalize on or avoid AI?
We at PIMCO, I know that we've downloaded the approved AI program, and many hundreds, in the high hundreds of people are regularly using it, I'm told. I'm not one of them, so I'm being old school. I've tried to use it, and I haven't found a way to apply it to portfolios. I manage core fixed income portfolios. I'm letting the people that, let's say, do research on credit, for example, they can use AI to canvas companies and keywords, et cetera, and gain insights that we wouldn't if we just use the human proxies. So I think it's in the research side, and it filters through to the PM, to the portfolio manager, ultimately. By the way, as an aside, I was happy to hear about new development in AI today from Paul McCartney, who said that he successfully they re-engineered John Lennon's voice for a song that will be released soon. So, if you're a Beatles fan, does anybody even remember the Beatles in this group? You're rather young. But lots of good things will come from it. But so we're trying to use it proactively and try to see how we can. It tends to wind up in the research realm and filtering through the PMs.
Yeah, it sounds somewhat similar. I mean, at Lazard, by the way, there are 3,000 people across the asset management, financial advisory businesses, and we've created you might say wasn't officially called a sandbox, but internally a defined, confined space where people can work with AI and try to find different ways to leverage it. But I would say this is an area of experimentation and learning. We're not putting it into portfolios yet. I mean, we got to learn how it works and make sure it's dependable and safe to use. There's kind of a Hippocratic do no harm element, but we think there are a lot of ways we can use it to increase efficiency. And so, this is something that's underway with several hundred of those employees, again, within a very confined safe space. Not in that psychological safe space sense, but more in a security safe space.
And I'll just add, we have a lot going on, really, in terms of understanding AI and its potential. Our focus has been creating an education piece on it for clients, just to understand AI in a very thorough way and also think about ways that one could invest in it. So that really has been a big thrust so far. Yes, sir. You may want to wait for the microphone.
I have one too.
Or
Sorry,
I'm so sorry. I apologize.
We can repeat back the question
We
as
can
well.
pass it over to you in a minute. When you guys were talking about risks in the market, and there were a couple things you cited that were risky but could break, like CMBS, and I think private credit was mentioning, but they're too small to really cause that, push us into recession. What about contagion? What about the risk of multiple of these too small items breaking? What bumps that into the recession piece?
So I guess in terms of breakage, first, a great innovation of the global financial crisis was the stress testing of banks. As we learned, it hasn't been applied to enough banks. So it does seem that the issues stop with the big banks, which would limit these systemic issues. But when we think, and Ron alluded to it earlier, thinking about the commercial mortgage-backed securities market, for example, we don't see much potential for contagion there because the amount of leverage there is significantly lower. It's a smaller portion, I think 15% of that part of the market now, much lower. I don't remember the old number, but as we go through the various metrics, the leverage is just a lot lower. And it starts with the GFC and that innovation with stress testing, forcing banks to hold more capital and to shift to a more traditional style of banking. What Marcia Stigum, who I co-wrote a book with on the money market, used to label 363 banking. She tried to joke, economists are bad at jokes, but 363 banking. Pay the depositor 3%, take in 6% on loans, and be on the golf course at 3 p.m. Very simple model of banking that many banks are returning to, and thankfully, in a way, because it limits the chances of systemic issues. So we find it difficult to find the linkages for these sorts of things at the current time.
Yeah, I mean, if I try to take a different angle on it, if I think about contagion, one thing I do worry about is the leverage lending space, underwriting standards, questionable at best in a lot of cases. Could you have a situation where you have a coalescence of problems in parts of the private credit universe, problems in leveraged loans, neither of which is big enough to be systemically dangerous, but then they cause fear across the credit spectrum? And again, I don't want to step on Tony's toes, but does that then widen spreads up the credit ladder? At the same time, you've got fragility in the banking system where people are already nervous about commercial real estate, and maybe that kind of reinstigates what was a run on the bank, became a walk on the bank, became kind of hanging out by the bank. What if it turns back into a run on the bank? I mean, you could piece together a waterfall of things that could go wrong. I do worry as well that U.S. bank regulators do not have the legal authority to just offer blanket guarantees on deposits like they did before Dodd-Frank. They kind of faked it and did it on a one-off basis during this downturn. So if there were a scenario where they're legally precluded and someone actually really enforced that and they couldn't backstop the banks, again, things could go there. But again, I'm really trying hard here to think of something like that. I guess the one other case, again, it goes back to sovereign issues. Berlusconi died. Right now, Berlusconi's supporters are in mourning. I wouldn't say the rest of Italy necessarily is, but his supporters are. That coalition could fall apart. Could you have italics at some point if you have the wrong? So I don't think we should discount that there are risks on that front as well. And at 160% debt to GDP, the pile of Italian debt is pretty massive.
And let me just quickly add to Ron's point, one of the key things, keep me up at night type of thing, is what I call a Keynesian endpoint, where we reach practical limits to the use of sovereign debt. Think of the UK last fall. It reached an endpoint where the government attempted, under Prime Minister Truss, to expand the budget deficit. And yields moved up dramatically, and the pound got pounded, no pun intended. If there's any additional attempts from here, given the experience we've had on inflation, which demonstrates the practical limits to the use of debt, I'll make the bet there's a violent reaction in the bond markets which could filter elsewhere unless that fiscal plan is eliminated as it was in the UK. So if the 2024, let's say for whatever reason, the parties in power in the United States were able to push through another multi-trillion-dollar package, I'll make the bet the bond market's in really bad shape, and it's lots of lots of bad effects from that.
And I would just add that I think those are very accurate concerns. But I have been really impressed with how sensitive policymakers have been to the potential for something to break because of this aggressive tightening cycle. And I think that perhaps might be the greatest advantage that markets and economies have right now is that we saw such a fast response to what happened in the UK last fall. We saw a very proactive US response to the regional crisis when it emerged. So I have a fair amount of confidence. I've also been fairly impressed with what we've seen in terms of confidence in markets, the behavior of credit spreads. So I think those are very real risks, but I think they're relatively low probability.
Thank you for the great panel. Maybe I'll change the gears a little bit. Like 35 years on average in the sector. What made them really go into the world of investment, 35, 40 years ago? And then for someone who starts going to the world of investment now, would they make the same decision basically if they were restarting their careers, or which kind of advice they would give people in the sector?
So I'll start. The question basically, in terms of if you were starting your career now, would you go into investments, and maybe some other thoughts there. I think the investing industry is perhaps the best job you could possibly have. Now, let's be fair. The three of us aren't going to cure cancer, right? We're not going to solve Alzheimer's. So the best job in the world would be to be the doctor or part of the team that does that, for humanity's sake. But this is a job where you get to manage money for some of the most important people. Everyone's important, but teachers, firefighters, police officers, you're basically making retirement and making college and making buying a home possible for people. So from a kind of what you're doing for society, it's great. From a personal perspective, it's intellectually challenging every day you walk in. You get to move around. It's an industry that has a lot of flexibility, that forces innovation and really welcomes innovation, in my experience, across different firms. And short of basically performing at sold-out stadiums like Taylor Swift and Beyonce, it's pretty damn scalable. If you're managing $10 million for family and friends, you can also manage $10 billion with the right team around you. And so it's a pretty amazing kind of compensation structure, which probably should change over time to be less lucrative for the managers. But it's a great space to be in. You just got to recognize you're not just competing with other people, you're competing with AI and all kinds of other kind of, data, technology, quant processes. It's an intensive industry, and I think everyone should recognize this is also an industry where people do not do this job until they're 70. It's the extreme anomaly to be able to last that long. I first was in trading and sales. Your seat could be emptied and replaced with someone else the next day, and your clients keep coming back as long as Deutsche Bank's got the credit line or JP Morgan's got the credit line. You're trading with JP Morgan. So it's one where you also need to constantly be developing your intellectual skills and your job skills to make sure you can do something else instead of that if you have to.
Ron said it exactly initially the way I would have as well. So I always tell the younger colleagues at PIMCO, get your head out of thinking about dollars and cents and think about the people. So I see a lot of people around the world, and I recognize the impact down to the smallest, in terms of numbers, investor. If we manage money well for a hospital, somehow we're helping that hospital to take care of a patient better. That matters to me, things like that. I was in at the Boys Town. Sorry, it goes back to a movie from 1938 with Spencer Tracy, who won the Academy Award for portraying Father Flanagan. He did a lot to help people, orphans. And I walked into the office, that's in Nebraska, and I saw a picture of Father Flanagan. And I connect the dots about what we do and what they do and how we help them with their mission. So that's the biggest thing. And the second thing about the excitement, I'm interested in sports, and we're playing and it's a game happening right here. And every day it's a game. There's a score. in terms of how things did in markets. And I love that. Love numbers, and you could look and see how society is faring. Are they buying lots of cars, homes? What's America up to? So you get to do that, right? Christina, you follow lots of economic numbers, you know. It can be a lot of fun in that way.
Yeah, I can't say enough good things. The ability to be an economist, a historian, a philosopher, a student over the course of a lifetime, and also just the ability, I think we all really benefit from interactions with clients, understanding what they're worried about. I think that's a virtuous circle. So you can come back and say, what can we do better to make their lives better and help them reach the outcomes they want to see. So I can't say enough good things.
My question is, each of you have shared a comment about potential recession or the fact that we may push through it as an economy. And if that's the case, I just have to ask, is the bond market, is the treasury, is the yield curve wrong, given the fact it's inverted? Because I've always heard that's one of those key indicators you certainly want to rely on with a pending recession.
Well, there's a study I've used for a long time by Estrella, E-S-T-R-E-L-L-A, and Michigan, former Fed governor. They have a table that shows the probability of recession given a certain 3-month, 10-year spread. And that currently indicates 70% odds of recession, which is extraordinarily high. I think there's a couple of things here, though. There's this suppression of long-term rates occurring from QE. One thing that Bernanke said to us many times, and many economists agree, is that the stock effect of QE is bigger than the flow effect. So the Fed took lots of bonds off the shelves, and so it's pushed up the prices of those bonds that remained. It's only slowly putting them back, so that term premium suppression lasts a long time. Some studies say 10 years, but the bulk of it's in the first few years after QE ends. So part of the inversion reflects that, but it also reflects the Fed's success, and it took decades to build up so that the curve now reflects it, in getting inflation down. It took a little while till a lot of people lost confidence, but they're back having confidence in the Fed eventually being successful in doing whatever it takes, and hearing that Powell is heeding the lessons of history, which is to take responsibility. It was the first thing he said yesterday in his press conference. Secondly, pay attention to people, how they feel about inflation. And third, to keep at it. He used that phrase too. Keep at it, of course, is from Paul Volcker, who Bernanke says is Powell's hero, and anybody's hero in central bank world, because only hawks go to central bank heaven. So keeping at it, which means they're going to get the job done and do whatever it takes, as Mario Draghi said in 2012. But final word is that it's probably accurate, and as Ron has said, and Christina, we're not expecting deep recession. It reflects a growth recession, which can feel like a recession in many ways. A growth recession ain't growth below 1.7, 1.8, but above 0. It's not technically a recession, but it's a growth recession because it's slower than the ability to produce goods and services, and that can build the slack up and get rid of the inflation problem. And so we might not need a recession to fix this, but we're leaning there, and that's PIMCO's view, is we'll get there second half of the year for various reasons. So the yield curve probably is right about the growth recession. It's a little bit distorted, and certainly would not bet against it in indicating conditions that will bring the inflation rate down. And that's what it's really telling us.
All right, well, I think we are at time. So before we stop, I want to thank my fellow panelists. It was so great to have you all.
Thank you.
Great to be with you,
and it was a wonderful conversation. I also want to thank my colleagues from Invesco. There are a large number of them in the room, and no one heckled me, so it was pretty amazing. But thank you all for staying. I know we ran over a little bit, but it was wonderful to be here tonight with you all.
Thank you all. Thank you.